So what I will do is basically I will deliver 1 hour, then stop 5-minute breaks, then another 55 minutes lecture, the recording purposes. As you are aware, today's sessions is impairment. At the end of the slide presentation, you will get a summary of this. Always when you study accounting standards, summary is important. We will start from the beginning. Accounting for impairment of assets, we are going to discuss LKS 36, which is labeled as impairment of assets under chapter 9. In financial accounting, you know very clearly the output is financial statements. When you take financial statements, basically there are components. Balance sheet, financial position would be one of the key report or key statement. So when you look at the balance sheet, you know the balance sheet is basically you have the assets and liabilities and equity. One side you have the resources, the other side you have the claims against resources. Resources we label as assets and claims we label as equity and liability. So if I ask you what is balance sheet, what do you mean by balance sheet? What is your answer? You may give different answers. You may say assets equal liability plus equity or financial position, different answers. But when you look at the balance sheet or the financial position at a particular date of a particular reporting entity, it shows the balance sheet shows basically the capacity of a business at that time, at presented date or prepared date. Balance sheet shows the capacity of the business. What do you mean by the capacity? So when you know this, we know that the capacity of this Zoom meeting is the students who have registered for the first year, second semester. Those who are taking financial accounting, maybe 1,100, maybe 1,200. That's the capacity. So in your house, you know your capacity. You might say, we have 2 bedrooms and one a kitchen and something like that. You might express the capacity. When you talk about a motorcycle, you might say, talk about the capacity of the engine. Likewise, you measure the capacity. The capacity indicates a particular meaning. We always try to increase the capacity. Increasing capacity is the purpose of the business. That is the normal trend. Increasing the capacity means increasing the resources. But since you are operating, since your business is operating in a particular context, particular environment, your business is subject to those environmental factors. Environmental factors may really have negative impact and positive impact. For example, you know, COVID situation, COVID-19, you know, had a negative impact for many businesses except few. It had a negative impact, you know, during that time. No business, no customers, government rules not to work, not to go out, you know, a lockdown. Then you don't have, you know, the credit worthiness. You can't make your liabilities, pay your liabilities, etc. So thereby, this is not limited to COVID-19. When you operate in a business environment is always volatile. I think you have learned this particular story maybe in first year under different subjects. So what I want to communicate to you is that the introduction part, the impairment is we are just going to recognize, or we are just going to respond. B means the balance sheet. Balance sheet is going to recognize, balance sheet is going to, respond to the environmental changes. So when you are trying to incorporate, when you are trying to really change your resources, your capacity, adjust your resources, when changing the business environment, so we technically call in accounting term impairment of assets. Basically, impairment of asset is responding to the business environment, maybe internal, maybe external. We'll see what it is. In this presentation, we have developed learning outcomes as usual. The first one is we talk about the impairment test for assets. Like you test for your, if there is something wrong in your body, you may have a test. Likewise, we also do the impairment test. Then we take, we do when to undertake an impairment test. We may discuss when to undertake, at which point we are going to undertake the impairment test. Then thirdly, they explain how to undertake an impairment test and accounts for an individual assets. So we are going to discuss how we are going to undertake the impairment test, and also for individual assets. And also we will discussing cash generating units, which is consist of collection of assets. We will define what it is later on. We call it cash generating unit. Cash generating units means we will discuss it, cash generating units, later on. Meaning is that cash generating unit, normally we do CGU. CGU means cash generating units. Then we will talk about little bit on accounting for reversals. As I told you, in certain cases, environment may generate threats for you, then impairment we talk about. In certain cases, certain points, certain, you get certain opportunities, then of course we talk about impairment reversals or impairment loss reversals. Then we will discuss the disclosure requirements. Basically, we will discuss under this chapter the meaning of impairment, impairment test for individual assets, impairment test for cash generating units, and reversal of impairment. So based on this learning outcome, as per the standards, there are three objectives. The first one is objective of the standard is to prescribe the procedure that an entity applies to ensure that its assets are carried at no more than their recoverable amount. Basically, what we are trying to say is that whatever the assets in your balance sheet, the carrying amount should not be more than recoverable amount. That is the first point. Always when you prepare our balance sheet, when we show our capacity, when we prepare financial statements, we are trying to ensure all our assets are really their carrying amount is not more than recoverable amount. So thereby you will see the recoverable amount is a new technical word. There is a specific definition for this recoverable amount. We will discuss that later on. Then impairment requires the carrying amount of an asset to be reduced to its recoverable amount. If any assets is really having more value than the recoverable amount, we have to reduce it to the recoverable amount. So that is called the what you reduce is called impairment loss. So basically, by adopting these standards, by following these standards, we are trying to ensure these three, we are trying to achieve these three objectives. Very briefly, we just want to ensure that our carrying amount, carrying amount is the amount which is appeared in the balance sheet, appeared in the books, appeared in the ledger, which is really the book value, carrying amount. Now, if you talk about the inventory, the carrying amount would be cost or net realizable, whichever is lower. I think you can understand the meaning of carrying amount. The second slide, next one. I just want you to, when you study accounting standards, one more common thing is you have to understand what is scope in and what is scope out, whatever the standards. When you do any professional work, what is important is to understand what is scope out and what is scope in. So thereby I thought of giving you what is scope out under LKS 36. Scope out means these are not coming under the impairment story, impairment recognition. Inventories out of LKS 36. Deferred tax assets out of this LKS 30. Likewise, employee benefits, financial assets under SLFRS 9, investment property valued at fair value, LKS 40, biological assets, LKS 41, insurance contracts, SLFRS 4, and held for sales assets, SLFRS 5. These particular areas will be covered not in LKS 6, but they will be, the whatever the reduction in carrying amount will be discussed in respective standards, not here. So thereby I think what is scope out is very clear. Then for this standard, we will be discussing this standard is applied to the following types of assets. For example, property, plant, equipment, which you have discussed already. Intangible assets, assets which are not really, in terms of physical existence. Investment properties measured using the cost model. Remember, earlier investment properties at fair value we really exclude from this standard, but investment property which are measured at cost model coming in to these standards. Then right of use assets which are coming under the leases. I think next chapter, next session would be the leases, and also subsidiaries accounting for under LKS 28, associates accounting for LKS 27, and joint ventures LKS 31, and goodwill are the example of assets which are really applicable for LKS 36. Right. Now we'll come to understand what is an assets impairment. As you see in the slide, an asset is impaired when an entity will not be able to recover its carried amount through using or selling. When you are using it for your business purpose, or when you're trying to sell it, if you are not covering, if you are not in a position to recover the book value or the carrying amount, we say that asset is impaired. Then carrying amount is here, the symbol meaning. What do you mean by this? More. Carrying amount is more than the recoverable amount. Then what is more is called impairment loss. Reducing carrying amount to the recoverable amount is impairment loss. So basically, if the carrying amount is higher than the recoverable amount, what is higher, what is more, will be labeled as impairment loss. Then when to undertake an impairment test? when to undertake an impairment test. Basically, assets at each reporting date, including interim date. Interim means when we prepare, we prepare financial statement for financial statements annually. In addition to that, depending on the other uh, regulatory requirements, we may prepare financial statements for financial statement partly. So those financial statement we prepare less than for one financial year is called interim financial statement. So thereby what I want to communicate to you is that the impairment test is applicable for reporting date, whether it is 1 year, 31st March 2000, say whatever, or for a particular 3 months ending period, if there is any indication that assets may be impaired. Test means we have to see whether are there any symptoms. If there are symptoms, yes, you have to do impairment test. We will discuss what are the symptoms later. Here the crucial word is indications, symptoms. If there are symptoms, yes, you have to do the impairment test. When? At each reporting date. How? When there are symptoms. Aim at this stage is not to perform impairment test, but to identify whether there are indications which warrant any impairment test. So thereby, your objective is not to do a impairment test, but to know whether there are any symptoms for us to, carry out the impairment test. If indicated exceeds, management is required to perform the impairment test. By using these slides, basically what we are trying to say is that impairment test is, or impairment test has to be carried out by management if there are indicators or symptoms. Then that is the general rule. What is the general rule for impairment test? Are there any symptoms? But there are 3 exceptional to this story. Those exceptional cases are discussed in these slides. The following assets must be tested for impairment annually, irrespective of existence of any impairment indicators. I think you can understand. Irrespective of normal condition is indicators. If there are indicators, yes, we have to do the impairment test. But even if there are no indicators, even there are no symptoms, intangible with indefinite useful lives, you know the meaning of intangibles, and intangible not yet available for use, that means you have purchased, sometimes not yet really use it. You have to do some installation, maybe some modifications. For example, if you just purchase a software system for your business from a vendor, so it is not yet not yet finalized, so there are certain additional works, so thereby intangible not yet available for use, we can categorize as intangible not yet available for use. Then third one is goodwill acquired in business combination. So you remember again, even though if there are no indicators, no symptoms, there are 3 type of assets which has to be tested for impairment annually, irrespective of indicators. As I told you again earlier, these 3 assets are basically intangibles. There are 2 types of intangible. Intangible with indefinite life. Indefinite means no use, no limited life. The lifetime is forever. The intangibles not available for use. Another one is goodwill. Then we'll move on to the indicators of impairment. Indicators, of course, are classified into 2 groups as per the LCS 36, internal and external. Of course, external means external environment, external sources. Internal means internal sources. My simple word is external sources means threats which are coming from the environment. Internal sources means weaknesses which you have really, which are inherent to your organization. Those are the internal and external sources. We'll see one by one. External sources: decline in market value of an assets. Of course, when market value of an asset is declining, you know, there is an indicator. For example, yeah, technological advancements. For example, maybe I think you can remember during tsunami time, tsunami period. So coastal areas land drastically reduce. You can remember the Meetotamulla case, the lands which are really surrounding under that, closer to that garbage dumping place, I think market value decline. So not only the technological advancement, but other maybe legal factors, legal matters, maybe some other, economic factors, maybe cultural factors. So due to these environmental factors, there is a possibility of declining in market value. Average changes in entity environment, adverse changes in markets. So if there is no market for your product, if there is no demand for your product, uh, the customers are just moving. Can you remember what happened to the Nokia? Adverse changes in entities, environments, maybe the business environment may have an impact on, negative impact on your machines, negative impact on your building, negative impact on your equipment, etc. Then the increase in interest rate. Of course, you should know that when increase rate is increased in any country, what happened to the market value? Market value is decreasing. When interest rate is reducing, market value is going up. When there are inflation situations, high interest rates with inflations, I think it's a negative factor, which is really indicator for impairments. The carrying amount of net asset is higher than its market capitalization. Simply, market price. You can compare, if the company is listed in the stock exchange, you can compare the market price with your book value. Book value means equity divided by number of shares. So you can compare. If your book value is higher than the market value, that means there is a problem in your asset base or the resources. So thereby, market capitalization, you can compare with your net assets. You know how to calculate the net assets. Net assets means total assets minus liabilities. Market capitalization means you multiply the market share by number of shares, outstanding shares. So those are external sources. Then we'll come to the internal sources. Internal sources, of course, obsolescence or physical damages may be due to a fire or physical damage. So you will see that your building has totally destroyed. So impairment is required. Changes in asset use has the assets become idle. During COVID time, COVID-19, certain businesses, factories, garment factories closed down. The certain manufacturing organization fully closed down for 3 months. So idling. And nowadays, even they are just running, but not at full capacity. So thereby, this is another indicator which is coming under the internal sources. Economic performance of the assets worse than the expected. Cash outflows are higher than expected. Maintenance cost, for example, hotels, no guests. So thereby your fixed cost is very high. You don't have any income. Cash inflows are lower than the expected. Basically, this is operational risk. So if you don't have enough business for your entity, of course you get economic performance, bad economic performance. Those are internal sources. In summary, what I want to communicate to any external, any business environmental threats, any business internal weakness, may have an impact on impairment of your assets, which is we consider as indicators. But the list which I discussed with you, only examples given in the standards, but we may produce a big list when you think further and further, depending on the different context and the scenario and the different economy environment. Then we will come to the impairment test for an individual assets. Now we are coming to the impairment test. You know when to carry out the impairment test. We are now just discussing impairment test of an individual assets. Okay. Then the impairment test for individual assets we are discussing. Here, just look at the table. You know the recoverable amount. We have mentioned it, but we will discuss what the recoverable amount in brief in the slides. Recoverable amount can be divided into two parts. One is fair value less cost to sell. Other one is value in use. Fair value less cost to sell, value in use, we take whichever is higher. Value in use, fair value less cost to sell. I will explain these two terminology later on, but for the time being, we have two amount as recoverable amount. One is fair value less cost to sell, other one is value in use. We take whichever is higher. Then we compare recoverable amount. We consider either fair value less cost to sell or value in use. We take it as a recoverable amount and we compare it with the carrying amount. As you know, if the recoverable amount is lower than carrying amount, impairment loss has occurred. If opposite, no further action is required, no impairment. Always we worry whether the carrying amount is more than the recoverable amount. Okay. Then impairment test for individual assets, the next one, of course, previous diagram shows that there are two possible amounts of against which carrying amount can be tested for impairment. Fair value less cost of disposal or where fair value less cost to sell. They both are same. Fair value less cost to sell, fair value less cost of disposal, both are same. Make a critical, like, you know, we talk it fair value minus dash CD, then the value in use. Value in use. Not always necessary to measure both amounts when testing for impairment. When we do the test for impairment, either one of these two amounts testing is enough. We just compare fair value less cost to disposal with carried amount. If it is more, so no need of carrying out the fair value test. For example, suppose fair value cost to this cost of disposal is 100. If carrying amount is say 70, carrying amount is 70, then of course you see 70 is more than the recoverable amount, but there is no need of doing the impairment. But on the other hand, we say recoverable amount is 70, carrying amount is 100. Now what do you see? Carrying amount is more than the recoverable amount. So thereby, this case, we need to do the impairment. Here the impairment is basically, how much the impairment? Impairment is 30 rupees. Impairment is 30. I think you can understand. So in this case, even one measurement is enough for us to do, for us to finalize whether the impairment is required or not. No need of calculating these two. Okay. Then we will impairment for an individual assets fair value less cost to sell. We will discuss one particular item, fair value less cost to sell, how to calculate it. So we take the fair value concept here. I think you can remember we discussed chapter 4 with you. Fair value, you know the meaning of fair value. Fair value is the exit price, price that really would be received for an asset, or price that really paid would be paid for a liability. You know, in the open in the market at a particular measurement date is called fair value. So thereby fair value and an exit price, we take the fair value from the market. So measured using the relevant valuation techniques. There are, I think you can remember, there are 3 valuation techniques. You can remember market value, income approach, and the cost approach. There are 2 types of variables: observable variable and unobservable variable. Value hierarchy. Observable means all the inputs you are taking from market. For example, if you go to the share market, if the price is available, it's an observable input. Unobservable means company specific, which are inherent to you. You don't have it, you know, publicly available. It's less publicly available. Those are called unobservable inputs. But my task is here not to discuss the fair value chapter, but you have to, again, if you are not familiar with this, you have to study this chapter. The cost of disposal covers legal fees, stamp duty, and transaction costs, cost of removing the assets, direct incremental cost to bring in the assets to a saleable condition. So basically, you take the fair value minus any costs which are relating to making the assets to a saleable condition. You reduce from the fair value. For example, suppose your fair value is 100, and say these cost, for example, cost of disposal is 5. So thereby 95 is the what you call 95 is the fair value less cost to disposal. I think with that we'll move on to the next one. Next, there's a small example given here. Just focus on that example. Example. Next, operating a leased premises. It owns a bottling plant which is situated in a single factory unit. Bottling plants are sold periodically as a complete assets. Professional valuers have estimated that the plant might be sold for 100,000. That means the particular plant can be sold. The market value is 100, which is fair value. Has charged fees of 1,000 rupees for this particular assessment valuation. Value has charged 1,000 rupees as optional fees. Assets and dismantle and assets and the shipping it to any buyer, 1,500 plus the 500, altogether 6,500. There are 4 figures. 100,000, 1,000 rupees professional fees, 5,000 which is dismantling, and legal fees is 1,005, shipping and dismantling. So if someone is buying this, there are extra estimated, selling cost. Compute the value cost to sell. So what would be the answer? Here, as you know, how do you calculate it? Can anyone think? Yes. So the fair value, what is the assessment is 100,000. Okay. And minus 6,500, which is selling cost. 6,500, which is the selling cost. So thereby, what is the answer? Answer is, of course, 93,500. That is the answer for this question. Fair value less to cost. What I want to communicate by using this slide is that the 1,000 rupees here is not coming under part of the selling, part of the assets which is required to convert into usable, saleable condition. So this is a professional fee which is related to the valuing of the asset. It's not a marketing, it's not a selling expense. So thereby we are not taking selling expenses, marketing, we are not taking professional fees which are just charges, assessing the market value or the fair value or whatever. We are not going to reduce it because those are not coming under the selling and the marketing expenses. Is it clear? Okay, then we'll come to the next one, impairment for individual value in use. Now we have discussed the particular fair value less cost to sell concept. Now we are moving to the value in use. Of course, value in use is much more entity specific concepts, not like market entity concepts. Okay. The present value of future cash flows expected to be derived from an assets or the cash generating units. Value in use means the present value. You know how to calculate the present value. You have to take the future cash flows of a particular series of particular assets. You may calculate the present value for an assets, for an individual assets, or a cash generating unit. I will discuss what is cash generating unit later on, not now. But basically, what I want to communicate to is the value in use is present value of future cash flows. Very simply, present value of future cash flows. Very simply. Okay. Then determine the future cash flows. How do you determine the future cash flows? Projection should be based on management best estimates and most recent budgets forecast. So when you do the future cash flows, of course, you have to project, you have to estimate based on the management best estimates and most recent budget forecast. Meaning is that you have to take update, up-to-date, accurate, reliable, relevance information to forecast. For example, if you take this year figure, 2018 and 19 financial data, sales figures, I think those sales figures are not really not perfect. Why? Because 2019 and 20 period is a specific period which we had last 3 months of the year COVID-19 impact. So thereby our sales figures are always subject to the impact of COVID-19. So thereby the 2019-20 figures are not reflecting, you know, a realistic situation of your business. So thereby, if you take such figures, those estimates are dangerous. That's why we label it as you should be based on the management best estimates, most recent budgets and forecasts. You have to be careful when you are taking the figures. Then the cash inflow should include those from continuing the use of assets. When you continue the assets, uh, you have to use it continuous basis, as well as the expected of the disposal of the assets. Cash outflows must also be taken into accounts when you are, that means cash in and cash outflow. I think you know what are cash in, cash out. The difference is net cash flow. So we forecast your future cash flows, assuming that your business will continue, your business will have a going concern. Basically, this when you take these two measurements, fair value less cost of disposal and fair value in use, we think that value in is much more specific to the business entity. So thereby, the accuracy of the, or the, you know, relevance or the completeness of the value or the accuracy of the value depends on accuracy of your estimates. Then when you do discounting, one side you need, as I explained you, future cash flows. I think you can remember how to calculate the net present value. If you discuss this in some other subjects, net present value has two elements. One is future cash flows, other one is discount rate. So further, I'm sorry, I'm just discussing the future cash flows further. When you do the future cash flows, you need to consider the current condition, not the future conditions, not the restructured condition. So you have to always consider the current condition. Suppose you have a machine which has the capacity of producing 1,000 units. So the current condition is 1,000 units. But you may increase the capacity of this machine by putting an additional technology. You can increase the capacity by another 20. Then your capacity is really your machine or the whatever the equipment you are talking is restructured. But what the standard says is that you have to use the current condition. Suppose you can produce 100 buns per day in your machine. So that is the current conditions. But you may increase, you may double the capacity by buying an additional machine or by putting additional technology. You may increase the capacity, but here the capacity has to be the current condition. Then the financing related tax and cash flows are excluded from the calculation. When you do the cash flow, what you have to do is you have to take the cash flow not including, that means excluding interest cost and the tax. So thereby in your cash flow statement, you are not putting interest expenses and the tax payment as an outflow. Cash flows on disposal should be taken into account. That also you have to put. Then determine the discount rate. Discount rate is, of course, you know, time value of money. You have learned this under financial mathematics. Time value of money. Then the risk specific, you need to adjust the risk-free rate to the risk factor. Then we'll move on to the impairment test for an individual assets, recognition and measurements of an impairment loss. And now you will realize this particular standard is not much familiar to you. Thereby, you may think, you may understand that this is complex. my opinion is it is not complex. Maybe it is new for you. So thereby you may think that it is difficult, but you need to read if you could understand uh, those matters what I explained. You have to read. So far, just to summarize what I discussed so far, I explained the meaning of impairment. What is impairment? Impairment is recoverable amount. If the recoverable amount, you compare the recoverable amount with carrying amount. If carrying amount is more than the recoverable amount, there is impairment. That is the first point we highlighted in our presentation. Second point we discuss when to do the impairment test. So impairment test has to be carried out at each reporting date if any impairment indicators are there, symptoms. But there are three exceptional. Intangible is the indefinite, intangible which are not used, and goodwill subject to annual impairment test even though there are no indicators. That is the second point. Third point we discuss what are indicators. We discuss under two heading, external and internal. My simple interpretation was that any threats coming out from external environment, any threats coming from the external environment, and any weaknesses inherent to your organizations are the symptoms, indicators, but you may have a big list, you may have examples, whatever the factor, any threats, any weakness can be considered as symptoms or impairments, indicators. Thirdly, we discuss the recoverable amount. Fourthly, really, there are two components of recoverable amount. The one is fair value less cost of disposal. Other one is value in use. We take whichever is higher as the recoverable amount. So those are the things so far what we discussed. We will move on to the recognition and measurements of an impairment loss with regard to individual assets. As you know, if the carrying amount is more than the recoverable amount, there is an impairment. When the asset is accounted for under the cost model, impairment loss is recognized immediately in the profit and loss. Impairment loss, P&L item, you recognize in the profit and loss account. But remember, under the cost model, if the assets carrying amount is under the cost model, so you recognize in the P&L. But where the asset accounted under revaluation model, if your assets is more towards fair value and the revaluation model, impairment loss is treated as revaluation decrease. It's a revaluation decrease. It's a revaluation decrease. So you charge it to the not to the profit and loss. Revaluation decrease increase we dealt in the OCI, other comprehensive income. So thereby it is not the P&L item. Mostly what we do is we charge the OCI just to decrease the revaluation reserve. Then any subsequent depreciation is based on the new recoverable amount. You have to remember when you take impairment, there is another story, depreciation and amortization. You discuss this under LKS 16. Depreciation is really, how do you define the depreciation? Depreciation is a systematic, that means it's a systematic allocation of, depreciable amount over the life of the assets. Depreciation, amortization, basically depreciable amount or amortization amount, you are just allocating for a limited period. We call it systematic way. When you do the depreciate, you do estimates. For example, you estimate the life, useful life, and you estimate the residual value. So thereby, if you do the impairment will force you to think about your depreciation charges or new recover based on the new recoverable amount. Then we will discuss the example for cost model. Asset has a CA 1 million and recoverable amount of 900,000. What is the impairment here? 1 million and 900. I think you will agree with me. 100,000 is the impairment, so that has to be charged to the P&L. Journal entry would be impairment loss debit, accumulated depreciation or impairment losses credit. That is the normal journal entry if it is cost model. How to do it? Impairment loss debit, accumulated depreciation, impairment losses credit. Here what I want to communicate in your books, if you have accumulated depreciation account, you have to rename your accumulated depreciation account as accumulated depreciation and impairment losses. Impairment losses chart of accounts you have to redefine, because earlier if you had accumulated depreciation, now just because of impairment recognition you may rename your accumulated depreciation account as accumulated depreciation and impairment losses. The balance of this account is now 700. Why you get 700? How do you get 700? You know 1 million is the cost. Sorry, carrying amount. Cost is 1.6 million. So thereby accumulated depreciation is 0.6, which is already in the balance of the accumulated depreciation account. With this additional impairment loss, which is credited to the accumulated depreciation account, the balance of the particular provision account would increase to 700. Okay. Then we'll move on to the revaluation model. Assets has a recorded fair value of 1.2 million. Accumulated depreciation is 2 million. Carrying amount 1 million and recoverable amount 900. Just see how do you do this. How do you do this? I think question is clear. Revaluation model. Recorded fair value is 1.2 million. Based on 1.2 million, accumulated depreciation is 2 million. So thereby book value is, carrying amount is 1 million. And recoverable amount 900. Of course, you know, impairment loss in this case is 100. Impairment loss is in this case 100. I will do some calculation if I put the answer, so you may really now carrying amount 100 million, say yes, yeah, I'll do that this way. Dahas walin ng 1,000. This is the recoverable amount. This is CA. You know meaning of CA. What is CA? CA is basically the carrying amount. RA is, you know what is RA? RA is recoverable amount, which is 100. This is the impairment loss. Impairment loss is 100. I think that is clear. But remember, we are in the revaluation model, not the cost model. When you do the revaluation, always what is already provided, the depreciation, you know, you have to reverse it. When there is a new figure coming into the carrying amount, into the books, you have to reverse it. So thereby, whatever the accumulated depreciation already in the books should remove from the books. So altogether, the full answer would be like this. Answer for this question would be like this. I think there is another additional information that you know, surplus is 500 previous revaluation. But how do you do it? This 200 accumulated depreciation, you have to reverse it. You debit the 200 to the particular depreciation provision account and credit the asset account. What happens is automatically this become 1 million. 1.2 becomes 1 million. Then, as I told you earlier, if there is a revaluation model, the impairment loss, which is 100 rupees, cannot be charged to the P&L. It has to be OCI. You debit the OCI and credit the asset account. That means by that amount also you are reducing the asset account. Automatically, what happens is asset account will become the recoverable amount. You reduce 200 from 1.2 million and you reduce 100 rupees, which is really 900. Then what happens is next journal is revaluation surplus you have to decrease by 100,000 and OCI credit. Now you will see these last two journal entries, debit OCI, credit OCI. Final journal entry would be assets account credit 100, revaluation debit 100. So thereby, if there is a revaluation model, what I want to communicate to you is that you have to remove the existing depreciation already in the books. You transfer the existing accumulated depreciation to the asset account or whatever the assets, and also the calculated impairment loss you are not charging to the P&L. You debit the revaluation surplus. The purpose is to reduce the revaluation surplus and to reduce the assets you credit it. So that is about revaluation model. I think now almost I have spent 1 hour. So thereby what I will do is I will have a small break just to record this, and within 5 minutes or once I record save this, I will come back, have a small have a rest. So within 5 or 7 minutes I will be with you.